I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a returned guest, a regular financial guru. He's rarely wrong. He's like a human computer. He's Michael Pento of Pento Portfolio Strategies. Michael Pento, thank you for joining us today on USAWatchdog.com.
Well, thank you so much for having me on the
Oh,
program. I am wrong. I just like to be right more than I'm wrong, but I've been wrong many times in the past. Let's just get that.
Did I stump you there?
Out of the way.
Did I stump you there? Well, you're right. You're not wrong often. I mean, you're not wrong often. You can't be because you'd be broke. So, but you okay? So we got that out of the way.
Right.
So I thought the shot froze. I'm thinking, what did we got?
Thank you for having me on the program. Oh, Greg, I just want to say something to you. You are a pleasure to be on with. You are the premier, what we'll say, off the grid, off the mainstream media source. And it's my pleasure to be on your show. And thank you for doing your program, USA Watchdog. You're a blessing to all Americans and many people all over the world, as a matter of fact.
You're very kind. Thank you very much. Listen, we were going to talk about this repo craziness that happened from September to the end of the year. But I want you get your thoughts because you invest, money and you look at stuff all over the place, including geopolitical. I know you're not an expert on the Middle East, but boy, just killed a general last week, and they had the embassy attack, and things are heating up. They had naval drills with China and Russia and Iran. I mean, what are you looking at in the Middle East with this latest thing where they killed an Iranian general and Mike Pompeo out saying it was preemptive strike?
Yes. So the nexus between what's occurring in the Middle East and what I do is oil prices. So I'm most primarily concerned with the price of oil. And you see Brent crude prices touch almost $70 per barrel and up to over 2.5% today, Friday, on West Texas Intermediate crude. So what I look at is a central bank, the Federal Reserve, is aggressively pursuing a higher rate of inflation, even though core CPI has been above 2% for the past 2 years. And now we have, on top of that core rate of inflation, the headline inflation, which is going to be surging because it's primarily influenced by energy, and food is influenced heavily by energy. And we have now killed, murdered, assassinated a very well-respected man, a general in the Iranian army. And I have to tell you, I don't know how Iran is going to react, but they will react to this. Now, they are a Shiite nation. It probably will look to strike against Sunnis, against Saudi Arabia. Their coalitions with Russia and China interplay in this. So they might have to launch some kind of cyber warfare against the United States. I doubt they will be. I doubt they'll have the temerity to actually engage the U.S. in direct warfare. But the bottom line is energy prices are rising while the Federal Reserve is aggressively pursuing higher inflation. So what do I get out of all this? Higher rates of inflation and an increasing rate of stagflation, because the growth, despite what many people say, the growth in the United States is anemic at best. It is nothing like we had in the 1980s. As a matter of fact, we have a global manufacturing recession. We have an earnings recession. And we just had a print today, Friday, of this day of this recording. We had the ISM's, the Institute Supply Management's manufacturing reading came in at 47, just above 47. This is a big miss and shows that the manufacturing recession in the United States is intensifying.
Is this what? And this is what I brought you on for, the repo market. And you were telling me that you just finished up work on the repo market and how much the Feds, they spent a staggering amount. And I see all these people celebrating, oh, the market grew 5,000 points in 1 year, first ever. And, oh, well, look at how much it was up, 29% or 30%, something like that. And I'm thinking, wow, I wish I didn't know what I know. I know how they did it. I mean, we were headed for another replay of 2018. And the Fed headed that off, did they not? I mean, we're going to have another 20-something% in the Dow and maybe 30 or 40 in the Russell 2000. I mean, tell me about your thoughts about what they did to keep from having another replay of 2018.
Or another replay of 2008. Again, if the economy is so good, And by the way, the Federal Reserve tells us over and over again, they have these stress tests for the banking system, right? And what are their conclusions? The banks are loaded with capital, they have plenty of liquidity, and they're massively solvent, right? All these banks pass the stress tests. If all these banks passed the stress tests with flying colors, then why did repo rates shoot up to above double digits when they're supposed to be down at 1.5%? If the economy is doing so well, why did the money market funds freeze up? Why did that occur? And I have my own theories on this. So I believe because of Basel III and Dodd-Frank, the banks have very little liquidity to start with. You add on top of that the fact that these banks have to take on over $1 trillion each and every year in annual deficits. So they have to buy a tremendous amount of treasury debt. So they have no liquidity, and their resources are taxed because they have to buy all this treasury debt. And then you add on to that the fact that CLOs, collateralized loan obligations, and triple C corporate debt are going insolvent. They are faltering quickly. So you add all those three things together and you get spiking repo rates. And then you have to ask yourself, if repo rates are spiking now, causing the Fed, remember everything's wonderful, the economy's the best ever, but the Fed injected $500 billion, okay, $500 billion into the banking system since mid-September. The Federal Reserve on January 2nd, Greg, of 2020, printed and shoved into the banking system $57 billion in one day to reliquefy the banking system. Everything is good. Everything is fine. The banks have no stress at all, and the economy is great. Yet we have built the Fed's balance sheet back to 4.2 trillion from 3.7 trillion in mid-September. Don't believe it. The fundamental structure of the economy, which is predicated and based upon sound fiscal and monetary policies, have never been more stressed in the history of the United States. And that is why you're seeing the repo market in disarray.
Let's futurecast here. So everybody was I mean you don't see this on CNBC or MSNBC or Fox Business or Fox News or ABC, NBC, CBS, New York Times, Wall Street Journal, Deal Book at the New York Times or Market Watch. You don't see any of this stuff. They're almost ignoring it. Did they fix the problem, or are they going to have to be back at repo hell in the future? Well, one day they put out $134 billion. I read one day.
$500 billion had to be added to the repo market in 3 months. So how in the world could they have fixed the problem? The economy, the global economy, on a global scale, continues to deteriorate. And you see corporate debt, which is the nucleus of the next crisis, continues to falter. So every time the Fed tries to pull away from its counterfeiting schemes, from its monetization schemes, the economy falters, the stock market craters, and the money markets freeze. So what they do is they come in with massive stimulus, as I said, almost $57 billion in one day, January 2nd. And what happens is zombie corporations, which are surging in numbers, tend to not only survive, but they thrive, and more corporations become zombie corporations. Let me give you a statistic for you. Not Michael Pento or Greg Hunter. The IMF has predicted that in the next recession, if it's only half as bad as 2008, 40% of the worldwide supply of corporate bonds and corporate corporations will become zombies. And let me define zombies. corporations that don't have the cash flow to service the interest on their debt. So you ask me, when can they stop? They can't stop. They're going to have to increase these repo facilities. They're going to have to increase the non-QE4. You know, they don't call it QE. I don't know why they don't. I mean, as if monetizing coupons or longer-term treasuries is QE. They acknowledge that. But somehow monetizing, printing, counterfeiting money, printing money, and buying short-term treasuries somehow isn't QE. I don't understand that. All that means, go ahead.
No, I don't understand it either. It's like, it's almost comical. It's like Baghdad Bob. We're going to destroy the infidels. As you know, A-10s are bombing in the background. Tanks are rolling up in the shot. We're going to kill the infidels. I mean, it's like there's no QE. What? Do you?
There's no right. We're buying hundreds of billions of dollars in treasury bills. Okay, that means the Fed has to roll over this. These maturities occur much quicker than they were if they're buying longer-term debt. They're rolling over this money more and more frequently, which means they have to print money more and more frequently. Added $500 billion in the last 3 months, and the banking system is healthy and completely solvent, but we still have to go and counterfeit money like it's going out of style. I mean, listen, you were once a reporter. I mean, I'm not a politician, and I'm a libertarian. I'm not a Republican. I'm not a Democrat. I voted for Donald Trump. I like most of his policies, but I'm not here trying to promote Republicans or Democrats. I just want to give you the truth. So the truth is, if the Fed tried to normalize interest rates from 0%, where they were for a whole decade almost, and then went to 2.5%, and then tried to drain its balance sheet, and they sold about $800 billion off of its balance sheet, and then the world ended in Q4 2018, and then they panicked. Remember, they were supposed to be raising rates in 2019. They cut rates 3 times in 2019. They went back into QE, and they actually started a repo facility, a continuously standing repo facility, and now they're telling us it's the best economy ever because the stock market went up. Well, of course the stock market went up because they keep on printing money like it's going out of style, but they just don't want you to acknowledge the fact. They don't want to acknowledge the fact that they're printing money like they've never done before. So, I mean, those are the facts. We just deal with facts here.
Could there be a grand scheme to reset? They keep talking about. I mean, Christine Lagarde's talked about this. The IMF, the reset. This is as far back as 2014. Right now, it's 2020, 6 years later. But they're talking about a grand reset. That at some point, we're going to have maximum debt saturation, or maximum inflation, or maximum both, and we're never paying this money back. We're going to default in some way, shape, or form. What's the end game? Are we just going to end up defaulting, or are we going to end up in a pink cloud of hyperinflation?
Well, let's see. So let's look at the facts. So global debt has now risen above $250 trillion. Let that sink in for a second. $250 trillion. And it's a record percentage, 330%, a record percentage of GDP. So we've never seen debt like this before in nominal terms. And even as a percentage of the phony GDP, which in of itself is engendered by free money, it's at a record. So the entire world has realized, the central bankers of this planet have realized that they are trapped. There is no escape from global massive debt monetization. And let me give you an example of this as my cell phone rings off the hook.
That's okay.
China, the People's Bank of China has cut the RRR rate, and let me explain that briefly. So it's the requirement reserve ratio in the fractional reserve banking system. Banks are required to hold some money on their deposits. It makes sense, right? I mean, if I go to a bank and deposit,
I'm sorry, we laugh. Banks are required to hold some money. Okay.
Exactly.
Okay,
So
go
that's
ahead.
called
So,
it's called the required. So if I just to explain it, I go to a bank and put $1,000 in, and they loan the $1,000 out. They give it to the next person. He deposits $1,000. We both of us idiots think that we have $1,000 in the bank. But if they keep loaning out that $1,000, we really have nothing in the bank. And if we go to the bank and say, Can I please have $100 of that money?" And they say, "No, we loaned it out. We don't have it right now." So they're required to keep something back. It's called the required reserve ratio. And that ratio is very small. But China cut that reserve ratio 8 times, 8 times since 2018. 8 times. So I'll give you more evidence. The ECB, remember under Mario Draghi, was talking about how he was going to raise interest rates in 2019 before he left and gave the baton over to Madame Lagarde. So he says he was going to raise rates. That was the plan, right? He not only didn't raise rates, he never got off zero, but he's now back fully into QE. Japan, the People's Bank of the Bank of Japan, they never even attempted or feigned any interest in ending their QE. They're still in the middle of debt monetization like we've never seen before in Japan. So you have China, Japan, Europe. The EU 19 is the biggest economy on the planet. And even our Federal Reserve, we are back in QE. We have a standing repo facility. We could only raise rates to 1.5%, and we're headed back to zero. So the only way this massive pile of debt is able to be serviced, even on the margins, is when money is free and central banks continuously debase fiat currency, which brings me to this notion of gold.
yes,
I
I
own
was going
gold
to ask you about
10%,
that.
physical gold 10% in the portfolio, and I have to wonder the pace of faith in fiat money is being eroded. But the pace of that erosion is quickly increasing. All the ingredients are there. So we have the US has 106% debt to GDP. The only time it was higher was in World War II, right after World War II. We have $1 trillion deficits in the best economy on the planet. If we had a recession, our annual deficit would go to 2.5 to 3 trillion, which would be about 15% of GDP, which would be, by the way, the denominator, which would be crashing. So it could even be higher than that. And this it's the same thing. This is replete throughout the world. Europe is in a mess, even though if you look at European bonds, Portuguese bonds, Greek bonds, they're almost the 10-year notes. They're almost close, they're close to 1% or below, even though they're insolvent nations, de facto insolvent nations. So you have to ask yourself, if we have massive debt in place already, massively increasing deficits that are growing intractable, you have central banks that are caught forever in perpetual 0% interest rates and never-ending debt monetization. You think about the level of negative real interest rates, which are falling because the Fed prints money, buys bonds, caps the interest rate. That the interest rate stays pretty much where it is, but the rate of inflation is increasing. And now I hear from the central bankers, especially in the United States, that they're panicked that inflation isn't rising fast enough. And you wonder, why isn't the faith in fiat currencies eroding even more rapidly? Well, it is going to. All the ingredients are there. And I think the pace of that erosion is going to become a deluge throughout 2020 and beyond.
Is this why we're starting to see this? Even though many people, there's lots of proof, lots of pleas, and lots of charges of manipulation of forex, gold, silver. Deutsche Bank, many other big banks have admitted to. So listen, we know it's rigged. Okay, the whole thing is rigged. All the markets are rigged. One's rigged in one direction, and one's rigged the other direction. But anyway, I digress. Even though the markets are rigged, and all we have are interventions and manipulations in all markets, especially in the gold market, and they're pushing it down always to make the dollar good. Is this why gold's copping a bid, catching a bid over 1,500? Is this why? Is this why central banks are buying gold in the bar market? They see this coming?
I think that's part of the reason. I think you're exactly correct. I also see that the world is moving away from dollars. I mean, China, Russia, and even parts of Europe, they want to conduct trade without having to rely on a very strong and stable dollar. Because, you know, we always could, since Paul Volcker, God rest his soul, since Paul Volcker to, you know, maybe very early, the first weeks of Alan Greenspan's tenure, actually this started, you know, prior to even Bretton Woods. People had faith in the dollar's purchasing power. But now, as we look around the world, we're starting to notice that the US dollar isn't really that much intrinsically different than the euro, the yen, or the renminbi. It really isn't. We suffer from the same conditions of fiscal and monetary madness. And I think the Russian central bank understands this, the Chinese central bankers understand this, and the European central banks understand it. That's why they're diversifying away from dollars. That's the primary cause here, or one of the primary drivers. And then when you add to that the knowledge, the zeitgeist of the day should be that central bankers are trapped and they can never raise interest rates. Real interest rates will be falling. And if you want any help, or if you want any chance of staying in the middle class, you have to preserve your purchasing power in real terms, and that means owning gold. And I just want to say a couple of things about the middle class. You know, the pace of the middle class evisceration around the world has been speeding up. Because why? Because central bankers have become trapped. They've become slaves to the J.P. Morgans of the world. They have been ensnared in this trap where they're just trying to keep the stock market afloat so Jamie Dimon can get his bonus. That's the real reason why central banks exist. Remember, central banks don't exist to help you. They are there to be the banker's bank. Okay? So the middle class, the top 1% of the world now owns 40% of the wealth. And the rate of increase of the wealth within the top 1% is growing now 5 times faster than the middle class. So the middle class is getting wiped out. Why? Because those in the middle class are forced to spend most of their income on energy, on housing, on healthcare, on food. A much greater percentage, 35, 40, 50% of their income just on those basic needs. They don't have 10 houses. They don't have a massive stock portfolio like some of us do. So that's why there's a trenchant gap, a widening gap between the richest of us and the poorest among us. And if you want and I'm speaking now directly to the middle class, if you want to maintain your purchasing power, you must begin to channel as much as you can towards physical precious metals, in my opinion. Maybe even above. I have 10% in the portfolio. I do a lot of technical analysis. I have a model that lets me know when to get more long of gold, and I intend to do so. And I would think that if you don't have at least 10% right now in physical gold, then you're doing yourself a great disservice.
And silver
and again,
is. Go ahead.
Go ahead.
No, go ahead. And again, go ahead. Go ahead. I'm sorry. Cut you off.
I will add that the allocation to precious metals, and I'll include platinum, gold, and silver in the precious metal basket. The amount of money that you have reserved, the percentage of your wealth, should be increasing as you go through time, because I believe, and by the way, I manage money for a living. I'm sorry, I'll let you in a second. I manage money for a living. I don't sit here and tell you for the past 10 years, buy gold, short stocks, you're going to be a real winner. It might surprise people to learn that I actually made money for my clients in 2019, and I did it in 2018. So I'm not going to give you my specific returns. I have to give you all of my returns if I give you any returns.
2018 was an awful year. I mean, the Dow was off
because I have a model. I have a model that lets me know when. So the model is designed to make sure that my money, which is in the portfolio, and my client's money can preserve our purchasing power during all economic cycles. And that spectrum ranges from hyperinflation, stagflation, all the way down to a deflationary depression. And we're going to have both. Because like you said, we're going to have a massive reset, and all of this debt has to be defaulted upon, and it's going to be defaulted upon two ways: through inflation and through explicit restructuring, which is an explicit default.
Yeah, we're not going to pay you back.
But knowing how they're defaulting upon this debt is going to make you solvent. So, for example, during stagflation and hyperinflation, you sure as heck don't want to own bonds, any bond at all, except maybe a TIP, a Treasury inflation protection security. But during a default that's explicit, a deflationary default, you want to own a whole heck of a lot of bonds. Well, where's your model? How do you know what to own? Well, we were long bonds in the fall of 2018, and now we're starting to increase our gold, and we also own Russia, we also own India, we own aerospace and defense. So we're not just always short the market and sequestered into gold. I'm not, like I said, my priority, my only goal is to make my clients money. I'm not a politician, and I'm not a spokesman for precious metals. But if you look at all of the ingredients that surround your decision as to when to increase your allocation to precious metals, all of those ingredients are in place and getting more so.
And for poor people, because a lot of people tell me, I'm not rich, I can't really, don't have 15 and change in commission. I guess it's probably close to $1,600 for an ounce of gold now. But I said, buy silver, it's cheap. Just buy silver. Is that a good advice to give people? Just buy silver. It's 17 with a commission, maybe $20 an ounce for an eagle. Isn't that just cheap insurance?
Okay, so silver does best when we have, not only we have inflation, but we also have growth. And say in the second derivative sense, you want to see growth accelerating, and you want to see inflation accelerating. If you have a condition where inflation is primarily accelerating and not growth, then gold tends to do better. This is just historically backtested. So you determine where we are at. I think we're in a condition of more stagflation, which tends to benefit gold more than silver. But if you can't afford gold, and the best you can do is silver, then that's better than nothing for sure. It's certainly better than holding fiat paper in a bank account that earns you far less than the rate of inflation. That's the rocket fuel for gold. If you think about what happened in the 70s, I mean, if even though interest rates were increasing in nominal terms, they were increasing far slower than the rate of inflation. I think that's going to be the case again, and that means you want to buy some more gold. And again, I'm not pushing gold. I'm just saying that'll be an increasing part of the portfolio.
And you wouldn't get hurt in that scenario buying silver. If all you can do is go down and buy a couple ounces of silver every week, go buy a couple ounces of silver every week.
Agreed. 100% agreed. 100% agreed.
Michael Pento, thanks for coming on and explaining what the heck is going on and why. I don't mean to be a bit, I don't want to be. I like Donald Trump. I like him a lot. He walked into office with $20 trillion, and we didn't even talked about the missing money, another $21 trillion. The day he put his hand on the Bible, like $40 trillion. They won't tell you about the $21 trillion. This is all documented by Dr. Mark Skidmore, so I don't want to get way off into that. But there's a lot of printed cash out there in digital form and whatever. And we just have a lot of debt. And thank you for coming on and explaining to us how dire this problem is and how you are navigating it with Pento Portfolio Strategies. Michael Pento, the website is pentoport.com. Don't you have a blog that you do too?
So I have something called the midweek reality check, and much like you, probably inferior to your great work, I say in all humility, I provide a lot of independent research. I also amalgamate a lot of research. I give you the truth every Wednesday, 52 weeks a year. Even on Christmas, I had and New Year's I had a podcast. So that's a free trial, 5-week free trial. If you like what you hear, it's only $49.99 a year.
Oh, wow.
Um,
That's every week.
so every week, and
Oh,
you get some really salient data points that everybody needs to know. And then if you have around $100,000, I'll actually manage money with you through Charles Schwab, who's my main clearing platform. We work together to make sure you preserve your purchasing power during all scenarios. And I hope investors aren't lulled to sleep by the wonderful year that we had in 2019. Because I'll tell you, earnings through 2019. Here's the truth. Ready? Here's some data point you won't hear on most of the mainstream media, but you'll get it on USA Watchdog. S&P 500 earnings growth in 2019 was a big, fat, juicy goose egg. Zero.
Wow.
Yet the stock market was up almost. The S&P 500 was up almost 29%. Massive PE ratio expansion, even though corporations are borrowing money to buy back their stock to make their phony earnings look even better.
Wow.
So if you're lulled to sleep and thinking that every year is going to be like that and want a top tick 1999, this is a 1999 scenario. When the music stops, there aren't many seats left, and you better make sure you know what you're doing. And God willing, I think I do.
Michael Pento, the website is pentoport.com. You see right there, Pento Portfolio Strategies, Money Manager Extraordinaire, and all around nice guy. Michael Pento, thank you for joining us today on USAWatchdog.com.
Thank you so much, Greg.